Hi everybody, this is Gil and this is your midday, intraday, Monday morning Go View video. We're going to review the webinar that we had at 9 o'clock this morning Pacific time. We did not record that, so what we want to do is go over the salient points that we made in the webinar for those of you who are not able to view it live. So you can see on my screen here we got a chart of the NASDAQ up, daily chart of the NASDAQ. Did a nice gap up to new highs. There was a closing high here, not seen, I believe, since late 2007. And then on Friday, the market gapped down on the poor jobs number. Notice how it filled the gap from Thursday and closed higher at the peak of the range. That looked constructive, but over the weekend we had news that Italy is starting to tip over here, starting to wobble a little bit. And that brought on selling today. That is taking the markets down pretty good as I speak, over 1% on the Dow, 1.73% on the S&P, and 1.94% at 10:11 a.m. Pacific time. So we're coming down. Now the market direction model went onto a buy signal, and we know that probably confuses a lot of you. But Dr. K is making that call on an objective basis, or on the objective basis, that we will have QE3 coming into play following a period of selling off here. So what we're looking at doing here is coming into the bullish ETFs slowly as the market comes down. It could come down 2 to 3 days. The fail-safe is going to be down here closer to the 50-day. So you are looking at maximum downside if you choose to buy into this and build positions as it comes down. If you choose to do so, then your maximum downside on a 1x ETF or 1 times leverage ETF, a straight ETF as you might call it, would be about 2-3%. That's what we're looking at. Now, our expectation is that you will probably continue to come down since you are selling off on heavier volume. But at some point, we'd look for the market to find a bottom in here. It should hold the 50-day, or which is also coinciding with this uptrend breakout or trend line breakout that you see here. So that's really how we're kind of playing it. So we take a 10% position in a bullish ETF here, see if it works, and maybe build into it as we come down. But you'll see how it develops. You want to take it very slowly. Nevertheless, you have to consider the fact that the market did come straight off the 200-day moving average. It is entitled to pull back here, and this has been a very news-oriented market, so we expect that that's likely to continue. So, you know, it's not the best environment for being aggressive, and as we've been counseling, you want to take things slow. You don't really want to make big commitments. If you see something that might work, then you take a shot at it. Of course, we did talk about a pocket pivot buy point on Friday in LinkedIn, and LinkedIn has just taken over MySpace as the #2 social networking company on the internet. And you can see you have the pocket pivot on Friday, and today you're trying to move up through the $100 level. My feeling is that if the market was up today, or if it was able to turn around and get back closer to unchanged or near the top of the daily range, you would see LinkedIn pushing towards the 110 area based on the Livermore century mark rule. The only problem today is that you have the tide moving against the stock, and so it's trying to go higher, but it is not really able to go too much higher based on what the market is doing today. So we still like the stock, though. We think that long term it will go considerably higher, but it may have to back and fill in here. Right now, on the near term, you can use the low of today or the 100 level as your downside stop if you decide to take an initial position here. Our idea here is to take a 10% position and then use the 10-day moving average as your guide for a stop. So a violation of the 10-day line would be our stop out point. So if you take a 10% position, you drop 10%, 10-12% from here before you're stopped out, you're taking a 1 to 1.2% loss to your total portfolio. We think that's worth the risk. If you don't like the trade and you think it's too risky given the general market action, then you can just lay back and wait for LinkedIn potentially to flash a second buy point at some point if it pulls back again. But for now, we're willing to take a shot here and see how this works out. Other than that, we don't see a lot to do on the long side of the market. We did note earlier that the GLD looked to be on track for a pocket pivot volume signature, not a pocket pivot buy point, because you cannot have a buy point when the stock is extended from the 50-day or the 10-day moving average. In this case, you'd want to see it closer and coming off of these moving averages to call a pocket pivot. But what we do note, and what we have been waiting for, is a breakout in gold through this consolidation that it's been in since early May. And so we'd like to see a breakout there. You can see in the past, whenever gold has come out of these consolidations, it's been able to have a decent upside move. You see this one here came out of Back here, it came out of this consolidation, was able to move higher. Back in 2009, it came out of this consolidation, was able to move a lot higher. So that's really what we're looking for right now. So we're just noting the positive action in the GLD, and we note that the dollar is up today pretty nicely because you're having movement out of the euro and into the dollar. You're also seeing treasuries do well. The TLT, for example, has gapped up 2 days in a row to get above its 50-day moving average again. So treasuries look dead early last week, and now this week they spring to life on what is essentially a fear trade as money moves out of Europe and into the dollar. So you would expect that the dollar moving higher, or rather let's use the dollar index here. With the dollar moving higher, you'd expect to see gold and silver selling off. Now interestingly, silver is the weaker of the two metals given its position down low in this pattern, is in fact down today. But the interesting observation today is that gold is higher and it's trying to push for its closing high here that we saw towards the latter part of June. Volume is also pretty big in the futures today, so we would have to get above this level though on this day to be a pocket pivot buy point on a breakout. So far we're not really seeing that. If you saw pocket pivot volume signature and it did have a clean breakout to the upside, that would be viable in our view, but it's not clear to us that you're going to see it because again it's swimming against the tide, and I would say not a heavy tide but a slight tide of the dollar rallying, and the dollar looks like in the near term it wants to go higher. But meanwhile, we know gold up at this time right now. It's 10:16 a.m. Pacific time on Monday morning. Gold is up $7.50 at 1549.10. So it's a very interesting development there. You also notice that some of the more recent breakouts, Racks tried to break out of a double bottom formation. We never talked about this on virtue of selfish investing, but it has failed at the pivot point. So if you did buy that breakout, you would probably want to be selling it on the basis that it can hold the breakout point. As I'm speaking, the market is getting worse here, so definitely want to be cautious here. If you are buying some positions in the ETFs, you want to keep them small, and you want to build your way in, keeping your downside to a minimum if the fail-safe does go off. So that's kind of what we're looking at here. But our take is that you are going to see QE3 come in. You have Euro QE is going to start coming in, and this may cause stocks to push higher simply on a nominal basis. Now, in real terms, it may be a different story if we continue with all this QE that continues to devalue the dollar and the euro. And that's really what we're looking at for today. We wanted to get this out to you just so for those of you who weren't able to attend the webinar earlier this morning that was live, we wanted to put this out for you to review. We will be having another intraday live webinar on Wednesday, probably 9 or 10 o'clock. We haven't decided, but watch for that invite. And that's pretty much it for now. So take it slow and be careful. You understand the rationale for going to a buy signal on the MDM. It's basically attributable to the fact that we see QE coming back into this market on this pullback, and so we're simply watching to see how this pullback handles itself. Okay? Take care.